In this video, we're going to take a look at basic break-even analysis problems, both with and without taxes. We'll begin with a basic break-even problem without taxes. First, we'll start picking up our per unit information. We've got a $1 per unit selling price, a 20-cent variable cost per unit, which means our contribution margin per unit is 80 cents. If we have fixed costs of 400,000, and we want to hit break even, again, we call break even is where net income is zero. That means we're going to need a contribution margin of 400,000 plus our zero for break even of $400,000. If we're making 80 cents in contribution margin per unit, the number of units we're going to need to sell in order to break even, we take our $400,000 required total contribution margin divided by the contribution margin per unit, and we find that break even would be at 500,000 units. If we had a target profit of $100,000, our analysis is much the same. The only difference is we'll begin with a $100,000 target profit. We have the same per unit selling price, the same per unit variable cost, and the same 80 cent per unit contribution margin. Our fixed costs were 400,000. Which means we will need to earn a contribution margin of 500,000, which is the fixed cost plus our target profit. At a contribution margin of 80 cents per unit, we're going to need to sell 500,000 divided by 80 cents per unit, 625,000 units to earn our target profit of $100,000. We're now going to consider several variations of our break-even problem. In the first one, we're going to calculate a maximum variable price per unit. In the second part, we're going to calculate a maximum total fixed cost. We're told that our selling price is $12 per unit. We have fixed costs of $1,700,000, and we have a target net income of $100,000 or $1 million. In addition, we are told that we have the capacity or will sell 540,000 units. Again, to begin with, our first step is to calculate our total contribution margin required, and that will be our target net operating income plus our fixed cost. We need to earn $2,700,000. If we can sell 540,000 units, we'll calculate our contribution margin per unit by taking the 2.7 million, dividing it by our 540,000 units, and we can see we're going to need to earn a contribution margin of $5 per unit. This means the maximum variable cost we can incur is $7, and that's the $12 selling price minus our required contribution margin. Now let's consider basically the same information, but we're told that our variable costs are $8 per unit, and we need to find our maximum fixed cost. Again, we're selling 540,000 units at a selling price of $12 per unit, which means we are earning a contribution margin of 12 minus 8, or $4 per unit. If our target net operating income, again, is $1 million, we can figure out our maximum fixed cost. Our contribution margin that we're going to earn will be the 540,000 units times $4 a unit, or $2,160,000. If we want to earn our target profit of $1 million, the most we can have in fixed cost is the difference between the 2.1 million and the $1 million, or $1,160,000. Now let's consider our situation with taxes. We'll assume we have a 40% tax rate. First, we'll calculate a break even, and then we'll calculate a target profit. Let's begin by picking up what we know. Our selling price per unit is $160. Our variable cost per unit is 40, which means our contribution margin is the 160 minus 40, or $80 per unit. Our total fixed costs are $400,000. And break even, recall, is where our net operating income is zero. To earn zero net operating income, that means our taxable income will also be zero, which means our contribution margin that we're going to require will be the 400,000 fixed cost plus zero for our break-even point, or 400,000. And our break-even point in units will be our 400,000 total contribution margin divided by our $120 contribution margin per unit, or 333,000 units. Notice, with or without taxes, our break-even point is identical, because if we have zero taxable income, we'll have zero taxable expense, so our net income will be the same as our taxable income. The situation changes a bit, however, once we consider a target profit. Again, let's pick up our basic information. Our selling price of 160 per unit, our variable cost of 40 per unit, which means our contribution margin per unit was the 160 minus the 40, or $120. Our fixed cost was 400,000, and we want to have a target net income, we're told, of $90,000. First thing we're going to want to do is pick up or consider our tax rate. A tax rate of 40 cents or 40% means that for every dollar in sales, we will get to keep 40 cents. We'll pay 40 cents and we will get to keep 60 cents. This is much like our contribution margin ratio from above. This means that if we want to have $90,000 in net income, our taxable income will have to be that $90,000 divided by 60%, or $150,000. We can check this by taking our 40% tax rate and multiplying it by our required taxable income. So if we need taxable income of $150,000, our fixed costs are $400,000. This means our required contribution margin will be the $150,000 plus the $400,000, or $550,000. At a contribution margin of $550,000 in total, if we make $120 per unit, we need to sell $550,000 divided by the 120, 4,583 units to break even. Next, let's consider a multi-product break-even analysis. This is the same assignment, or similar to the assignment you're going to need to build for an Excel worksheet for homework. We have 3 steps. First, we're going to calculate our combined contribution margin ratio. Next, we'll calculate the level of sales required to earn our target profit. Finally, we'll calculate the sales for each of our individual products. Let's begin with product A. We've got 100,000 units times $150 per unit. We have 1.5 million in sales and a variable cost of $100 per unit times that same 10,000 units, which means our contribution margin ratio is the 1.5 million minus 1 million, or 500,000. For product B, we have 1 million in sales, 650,000 in variable cost, and $350,000 contribution margin. We need to calculate the combined total for our company, which is product A plus product B. We've got 2.5 million in sales, 1.65 million in variable cost, and a contribution margin of 2.5 million minus the 1,650,000, or $850,000. We need to calculate the contribution margin ratio again, which is everything scaled by sales. So for every $1 in sales, our variable costs are 66 cents, which means our contribution margin ratio is the 1 minus the 0.66, or 34%. Our second step is to calculate then the level of sales required to earn our target profit. Again, we're going to go with a no tax situation. Our target profit was $6,000. Our fixed cost is $400,000, which means we need to earn a total contribution margin of $6,000 plus $400,000 of $406,000. We're going to pick up our contribution margin ratio from part 1 of 34%. And if we take our $406,000 divided by 34%, because we're keeping 34 cents for every dollar we had in sales, we see our required level of sales to earn our target profit is $1,194,118. Finally, we need to calculate the level of sales for each product. We do this by first calculating our current sales mix because our underlying assumption is our sales mix remains constant. Our sales mix for product A is the 1.5 million divided by the 2.5 million, or 60% of our sales are for product A and 40% of our sales are product B. We can now apply that sales mix to our total required level of sales at break even, and we get sales for product A of $716,471 and sales for product B of $477,647. If we want to calculate the number of units required, we simply take each one of our selling total sales and divide it by the sales price. So for product A, $717,471 in sales divided by a $150 per unit sales price means we need to sell 4,776 units. For product B, we're going to divide our total sales by the $200 sales price, and we get a target profit level of sales of $2,388,000. And again, keep in mind, if we were to look at the contribution margin ratio for each one of our individual products, we would see that we have a 35% contribution margin ratio for product B, and we would see we only have a 33% contribution margin ratio for product A. If we shifted more of our product mix towards product B, our break-even or target profit level of sales would drop. Finally, as a fourth step, we can prove that this is indeed the level of sales we need to break even. We take our units in sales times our selling price, our units in sales times our variable cost per unit, and we see our contribution margin for product A is $716,000 minus the $477, or $238,000. For product B, again, we take our units times our selling price to get the sales, our units times the variable cost per unit to get our variable cost, and we see for product B we have a contribution margin of $167,176. Our combined contribution margin is $406,000, which, given our $400,000 in fixed costs, indeed does leave us with our target profit of $6,000.